In 2008, Sears CEO Eddie Lampert tried something radical, and on paper, it wasn't a crazy idea. He split the company into more than 30 separate business units, each with its own president, its own profit and loss statement, its own budget, and each competing for internal resources like independent companies operating inside a shared building. Appliances became its own unit. Apparel became its own unit. Even functions like human resources and IT got restructured to bill other divisions for their services rather than operating as shared company-wide infrastructure. The theory behind it was pure free market logic, and it came from somewhere specific. Lampert was a hedge fund manager by background, and he was an outspoken admirer of economist Friedrich Hayek's writing on decentralized decision-making and price signals. The bet was that internal competition would force each unit to operate as leanly and efficiently as a real company facing real market pressure, instead of coasting as one anonymous department inside a sprawling bureaucracy. If markets allocate resources better than central planners do, the logic went, then simulating a market inside Sears should outperform a traditional top-down management structure. What actually happened was internal warfare, and it's genuinely one of the more thoroughly documented case studies of a structurally sound-sounding idea producing the opposite of its intended effect. Appliances and apparel divisions stopped cooperating on basic operational things because helping another division succeed meant, under the new incentive structure, giving up resources, credit, or leverage that would otherwise count toward your own division's numbers. If appliances agreed to prominent shared floor space near the entrance of a store, that decision came at the literal expense of apparel's own square footage and, ultimately, its own performance metrics. Every square foot, every marketing dollar, every bit of executive attention became a zero-sum negotiation between units that, from a customer's perspective, were supposed to be the same company. A detailed 2013 Bloomberg Businessweek investigation, based on interviews with numerous former Sears executives, laid out just how far the dysfunction went. Executives fought over which unit got credit for a shared sale, since a customer buying a washer-dryer set with a matching set of towels touched two separate divisions, and both wanted the transaction counted toward their own numbers, rather than split or shared. Divisions started buying advertising against each other inside the same company, literally competing for the attention of the same customer walking through the same store as if they were unrelated retail chains fighting for market share, rather than departments of a single business. Some units reportedly preferred a competitor win a sale over another Sears division winning it, because a competitor's win didn't show up as a loss on their own internal scoreboard the way an internal division's win did. Store maintenance became one of the most visible casualties, and it's the detail that made the collapse legible to ordinary customers who had no idea about the internal restructuring driving it. Nobody wanted to pay for shared building costs, since a leaking roof or a broken escalator benefited every division operating inside that store equally, and under a system built entirely around unit-level accountability, nobody had individual incentive to spend their own budget fixing something that helped everyone else for free. Sears stores visibly deteriorated over the following years, publicly documented in photo essays and news reports showing broken fixtures, empty shelves, and stores that looked abandoned well before they actually closed, while executives one level up argued over internal transfer pricing for exactly which unit should have paid for the repair nobody made. Lampert genuinely believed incentives would self-organize the company better than centralized management could, and that belief wasn't fringe or obviously foolish going in. Decentralization has worked well in plenty of large organizations, and internal competition between product lines can sharpen performance when it's structured carefully, with real coordination mechanisms and shared incentives layered on top of the competitive ones. What Sears actually built skipped that layering. The incentive structure optimized each unit for looking good in isolation, on paper, at the direct expense of the company functioning as a coherent whole in the store, on the floor, in front of an actual customer. There was no counterbalancing mechanism rewarding cross-division cooperation, no shared metric tying divisional success back to total company health, nothing pulling the units back toward the center once the centrifugal force of internal competition took hold. A structure built entirely around beating your internal colleagues will, predictably, produce colleagues who organize their behavior around beating each other and every other outcome, including the health of the shared business they technically both worked for, becomes secondary. Sears filed for bankruptcy in 2018, a decade after the restructuring began, and it would be dishonest to pin the entire collapse on the divisional structure alone. Online retail competition from Amazon and a broader structural decline across American department stores clearly hurt every traditional retailer during that same decade, Sears included. But insiders interviewed across multiple investigations, including the Businessweek piece and later retrospectives after the bankruptcy filing, consistently pointed to the internal divisional structure as an accelerant, a self-inflicted wound layered on top of external pressure the company was already struggling to survive. A retailer with real external competition needed every internal advantage it could get: coordinated merchandising, shared customer data, a unified in-store experience, and the divisional structure took several of those levers away right when the company needed them most. It's worth sitting with just how deep the internal accounting went, because the specifics are what make this more than a vague morality tale about silos. Each of the roughly 30 to 40 units, depending on the year, had to negotiate internally for services that used to just exist as shared company infrastructure. Legal counsel, IT support, even the physical space inside stores got priced and billed between units as though they were external vendors transacting with each other. That sounds efficient in theory, forcing every function to prove its value rather than existing as an unquestioned overhead line. In practice, it meant executives spent enormous amounts of time and energy negotiating internal contracts and disputing internal charges, time that, in a normal company, would have gone toward actually running the business or serving customers. Former executives described sitting in meetings that were less about strategy and more about accounting arbitration between units that technically reported to the same CEO. It's also worth contrasting Sears against organizations that decentralized successfully, because the failure wasn't decentralization itself, it was decentralization with no shared glue holding the pieces together. Berkshire Hathaway is famously decentralized, letting its many subsidiaries operate with enormous day-to-day autonomy and separate management. But Berkshire's subsidiaries aren't competing with each other for the same customer inside the same physical store, and capital allocation decisions still flow through a center that evaluates the whole portfolio, not just each piece in isolation. The difference between healthy decentralization and what happened at Sears comes down to exactly that missing center. Autonomy at the unit level works when there's still a mechanism, financial, cultural, or structural, pulling everyone back toward a shared outcome. Sears built the autonomy and skipped the mechanism. It's worth walking through a few smaller, more recognizable versions of this same dynamic, because the Sears story is dramatic enough that it can feel like something that only happens at the scale of a collapsing national retailer. It doesn't. The same structural mistake shows up at much smaller scale constantly. Picture a mid-sized company that splits its sales team into regional units and ties bonuses purely to each region's individual numbers, with no shared metric for total company revenue. A lead generated in one region, but genuinely better served by a rep in another region, maybe because that rep has the right relationship or expertise, becomes a fight over which region gets credit rather than a simple handoff. The company loses deals, or closes them slower, purely because crediting logistics got in the way of routing the work to whoever could close it best. Nobody did anything individually irrational. Every rep and every regional manager acted exactly as their bonus structure told them to. Picture a product company where engineering and sales operate as separately measured units, engineering on release velocity, sales on quarterly bookings. A sales team under pressure to hit quota promises a custom feature to close a deal, without checking with engineering first, because the sales unit's own metric doesn't include engineering's capacity or roadmap at all. Engineering, measured purely on their own release timeline, resents the surprise commitment and deprioritizes it, or builds it grudgingly and poorly. The customer gets a rushed feature nobody's proud of, and both departments walk away with a completed metric for their own scorecard and a worse product for the company as a whole. Picture a company that measures individual support agents purely on ticket closure speed, with no shared metric tied to actual customer satisfaction or retention. Agents start closing tickets fast, rather than, well, sometimes closing genuinely unresolved issues just to hit their personal number, pushing the real problem back to the customer to reopen later as a fresh ticket that resets the clock. Every individual agent metric looks fine in the dashboard. Customer churn, the thing the department was actually supposed to prevent, climbs anyway, and it takes months before anyone connects the dashboard numbers to the churn numbers because they live in entirely separate reports built by entirely separate teams who don't compare notes. Picture, finally, a company splitting a single product's marketing and growth functions into separately budgeted teams competing for the same finite ad spend approval from finance. Each team builds their pitch to look as strong as possible in isolation, sometimes overlapping, targeting on the same customer segment without realizing it, because neither team has visibility into what the other is bidding on. The company ends up bidding against itself for the same ad placements, driving up its own acquisition costs, a purely self-inflicted inefficiency that a shared budget and shared visibility would have caught in 5 minutes. In every one of these smaller scenarios, notice the exact same shape as Sears. A metric gets defined at the unit level. The unit optimizes for that metric, rationally, because that's what it's measured and rewarded on. And the sum of every unit hitting its own number perfectly still adds up to a worse outcome for the company as a whole, because nothing in the incentive structure ever asked any individual unit to care about the whole. There's a fifth version of this worth, including, because it's the one that tends to sneak into companies that would never dream of formally splitting into 30 competing divisions the way Sears did, and that's exactly what makes it dangerous. Two product teams inside the same company end up building overlapping features because nobody centrally tracks what each team is working on, and each team is measured purely on their own shipped output for the quarter. Neither team is doing anything wrong by their own scorecard. Both ship on time. Both hit their targets. The company as a whole ends up with duplicated engineering effort, two half-finished versions of roughly the same capability, and a confused customer-facing team trying to explain to customers why there are two similar features that don't talk to each other. Nobody conspired to create the redundancy. It emerged naturally from measuring each team only on their own output, with nobody accountable for the total picture across teams. The common mistake managers and executives make here isn't believing in accountability or internal competition, both of which are genuinely useful tools used correctly. The mistake is assuming that measuring units separately automatically produces a healthy company overall, as though individual optimization simply adds up cleanly to organizational optimization, the way pieces of a puzzle assemble into a picture. It doesn't work that way, because units under competitive pressure don't just work harder within their lane. They optimize aggressively for exactly what's being measured, including finding ways to win that unintentionally damage whatever isn't being measured, like cross-team cooperation, shared infrastructure, or the customer's actual experience moving between departments that internally think of each other as rivals. The fix isn't abandoning accountability or reverting to a single undifferentiated department where nobody owns a clear number. It's making sure every unit-level incentive sits underneath at least one shared metric that only improves when units actually cooperate, and making sure leadership rewards behavior that helps the whole company, even when it costs an individual unit something on paper. That could be as simple as tying a meaningful portion of every division leader's bonus to total company performance alongside their own unit's number, so that starving a sibling division of resources to inflate your own metrics stops being free. It could mean creating a genuinely shared metric, like overall customer satisfaction or total combined revenue per store, that no single unit can hit without the others also succeeding. It could mean deliberately building in forums, joint planning sessions, shared dashboards, where units are forced to see the trade-offs their competition creates for someone else. Instead of optimizing in isolation with no visibility into the collateral damage, there's a practical test any manager can run on their own org chart right now, without waiting for a Business Week investigation to point it out after the fact. Take any two units, teams, or departments that sit next to each other and ask a simple question. If one of them made a decision that clearly helped the total company but cost their own unit's number on paper, would they actually make that decision? Or would their own incentive structure quietly punish them for it? If the honest answer is that the rational move under the current incentive structure is to protect your own number even when it costs the company something bigger, That's the exact structural gap that turned Sears divisions into rivals instead of colleagues. It doesn't require 30 formal business units and a hedge fund manager's theory of decentralized markets to create that gap. It just requires measuring people narrowly enough and rewarding them consistently enough for hitting that narrow measure that the narrow measure quietly becomes more real to them than the company it was supposed to serve. The lesson from Sears isn't that internal accountability is bad or that competition inside a company is inherently destructive. Plenty of well-run organizations use internal benchmarking and healthy competitive pressure to genuinely sharpen performance. The lesson is narrower and sharper than that. If you reward units purely for beating each other, with no counterweight tied to the shared outcome, don't be surprised when they optimize for winning internally instead of serving the company or the customer at all. Sears didn't die because its divisions failed individually. Several of them hit their own numbers repeatedly, right up until the whole structure collapsed around them. It died because nobody was measured on whether the whole thing still worked. If your org chart is quietly turning departments into rivals, subscribe before you find out the hard way, like Sears did.